Last month, 23 dealers showed up at a Chinese EV factory and refused to leave. The company owed them 6 months of money. Their customers had cars that no longer worked, and the people responsible had simply stopped answering the phone. If dealers with contracts and lawyers can't get answers, what chance do you have as a buyer? 5 brands are collapsing right now. One of them probably has a showroom near you. Polestar. You've probably seen Polestar showrooms in your city. The sleek displays, the Volvo connection, the premium branding that suggests Scandinavian quality and engineering excellence. What you haven't seen is the financial disaster happening behind the glass. Polestar's stock has crashed 95% from its peak. The share price fell so low, down to 22 cents, that Nasdaq threatened to delist them entirely. The company had to do an emergency reverse stock split just to stay on the exchange. That announcement immediately triggered another double-digit crash in the stock price. Investors saw the desperation move for exactly what it was. In September 2025, Polestar issued what's called a going concern warning. That's accounting language for "we might not survive." The company's own filings acknowledged material uncertainty about whether Polestar can continue operating as a business. When a public company tells shareholders it might not exist next year, that's a red flag you can't ignore. The numbers tell the story. In the first half of 2025, Polestar lost $1.19 billion. Their asset to liability ratio hit 217%, meaning they owe more than double what they own. Cumulative losses since launch have now exceeded $6 billion. Last quarter, despite selling 14,192 vehicles, up 13% year over year, gross margin deteriorated to negative 6.1%. They're losing money on every car that leaves the factory. For dealers, this creates an impossible situation. Polestar went through layoffs in 2024, 15% of global staff gone. They lost Volvo's financial backing entirely. They closed their UK engineering operations, laying off 130 people and shutting 2 R&D facilities in Nuneaton and Coventry. The head of electrical engineering described watching nearly 7 years of hard work being dismantled as gut-wrenching. He wrote on LinkedIn that British engineering is the best. We need to stop this great British industry from disappearing. In China, the world's largest EV market, Polestar has effectively retreated. They sold just 163 vehicles in the first 10 months of 2025. They closed their last direct sales store and shifted to online only. For a brand that was supposed to compete with Tesla globally, selling 163 cars in 10 months in the world's biggest market is an admission of failure. For you as a buyer in Canada or the US, here's what this means. Polestar pulled their China-built Polestar 2 from the US market due to tariffs. That leaves buyers heavily reliant on the $68,000 Polestar 3 SUV. Not exactly a mass-market vehicle. Parts and service now come from a brand burning through $1.6 billion in cash annually with no clear path to profitability. Warranties are backed by a company that just warned investors it might not survive. The Geely parent company keeps injecting cash. Li Shufu personally invested $200 million in June 2025. 5 months later, that investment had lost more than half its value. Even the owner's rescue money can't stop the bleeding. Polestar is still operating. Dealers are still open. Cars are still being sold. But would you spend $70,000 on a vehicle from a company that filed a going concern warning? Would you sign a service agreement with a brand that's lost $6 billion and counting? The dealers in Europe who ask those questions too late are learning what happens when a premium EV brand can't pay its bills. Canadian dealers considering similar partnerships should take notes. A 95% stock crash sounds bad. Wait until you see what 56 cars sold in a month looks like. NIO. NIO promised to be China's answer to Tesla. Premium electric vehicles with battery swap technology and luxury service centers called NIO houses. In early 2021, the stock traded above $60 per share. Analysts called them a Tesla killer. The battery swap concept, drive in, swap your depleted battery for a fresh one in minutes from seemed genuinely revolutionary. Today, NIO trades around $5. The stock has crashed 95% from its peak, and their European expansion, the one that was supposed to prove they could compete globally, just collapsed in spectacular fashion. In January 2026, NIO sold 56 vehicles across all of Europe. 56. In Germany, Europe's largest automotive market, they registered just 1 single unit that month. By February, the total for Germany reached 6 vehicles. 6 cars sold in Europe's most important automotive market in an entire month. Then NIO dismantled their entire European management structure. According to internal documents leaked to European automotive media, NIO broke their European operations into 6 separate departments in February 2026. They fired their head of German operations, David Sulzer, who had presided over what the leaked documents called the sharpest sales decline in the brand's European history. They transferred their sales division to headquarters in China. The direct sales model that defined their European entry abandoned entirely. They're now scrambling to find dealers and distributors who will take over selling their vehicles. NIO Deutschland, their German subsidiary, lost more than 58 million euros on its 2023 operations alone. The 2024 and 2025 numbers haven't been released publicly. The cumulative losses for the entire company have exceeded 100 billion yuan, roughly 14 billion US dollars. In 2024 alone, NIO lost approximately 100,000 yuan on every single vehicle they delivered. They're not just losing money as a company, they're losing money on each car. Here's what happened to NIO's European dealers and partners. They invested in training for battery swap technology. They built showrooms to NIO's specifications. The company required specific design standards for their NIO houses. They hired staff, ordered parts, developed service capabilities for complex battery systems. And now NIO is retreating to China and hoping someone else will pick up the pieces. The company has been building battery swap stations across Europe, infrastructure that requires massive ongoing capital investment. Those stations were supposed to differentiate NIO from competitors. Instead, they've become expensive obligations that drain resources, while the company can't sell enough cars to justify them. For Canadian and American buyers watching NIO's potential expansion, this matters directly. NIO's president said they'll lay the foundation for overseas expansion in 2026, with targets of several thousand units delivered outside China. That's the optimistic version. The realistic version is a company that's never made a profit in its entire existence, that's lost $14 billion, and that just abandoned its European operations after selling 56 cars in a month. The battery swap stations that make NIO unique? They require massive capital investment that a money-losing company can't sustain indefinitely. The premium service model? It bleeds money faster than vehicle sales can replace it. The technology is genuinely impressive. The financial sustainability is non-existent. European dealers learned this the hard way. If NIO announces Canadian partnerships tomorrow, ask yourself, do you want to be the next market they enter with grand promises and then quietly abandon when the numbers don't work? At least NIO's losses were expected. The next brand was supposed to be the exception that proved Chinese EVs could work. Li Auto. Li Auto was supposed to be the exception, the profitable Chinese EV startup, the one that actually made money while NIO and Xpeng burned through investor cash. Industry analysts held them up as proof that Chinese EV companies could build sustainable businesses without endless funding rounds. Their extended-range electric vehicles, essentially hybrids with gas generators, hit a sweet spot for Chinese buyers worried about charging infrastructure. Then 2025 happened, and everything the industry believed about Li Auto turned out to be temporary. In the third quarter of 2025, Li Auto posted their first loss in 3 years. Revenue fell 36% year over year. Vehicle deliveries collapsed 39% from 152,831 units to just 93,211. Their vehicle margin compressed from 21% to 15.5%. For a company that built its reputation on profitability, watching margins evaporate while deliveries cratered sent shockwaves through the industry. The immediate problem? A massive recall combined with intensifying competition that exposed how fragile their position actually was. Li Auto's Mega MPV, their premium electric minivan priced above $70,000, experienced battery-related fire incidents. The company had to recall more than 11,000 units and set aside over 11 billion yuan, roughly $1.5 billion, to cover the costs. That single recall wiped out an entire quarter's potential profit and pushed the company into the red, but the recall just accelerated a decline that was already underway. The company's L-series hybrid SUVs, the L7, L8, and L9 that built their reputation, faced brutal competition from BYD, Huawei's Aido brand, and Xiaomi's surprising entry into the automotive market. HSBC downgraded Li Auto from buy to hold and slashed their price target by 38%, citing major recalls, delivery issues, and falling sales. JP Morgan went further, downgrading to underperform and forecasting a 10% sales decline through 2026. By January 2026, Li Auto delivered just 27,668 vehicles, their 8th consecutive month of falling deliveries and their lowest volume since March 2025. That's 8 months of continuous decline with no sign of stabilization. For dealers who partnered with Li Auto expecting the profitable Chinese EV startup, the reality has been brutal. The company is now offering rebates of 20,000 to 30,000 yuan per vehicle just to move inventory off dealer lots. Those discounts erode margins for everyone in the sales chain. Staff hired during the growth phase are being cut. Showroom traffic has declined alongside sales. The premium positioning that justified higher prices has evaporated as competitors offer similar features for less money. If you were considering a Li Auto vehicle for the Canadian or US market, here's what you need to know. Li Auto has no current plans for North American expansion, but if they did arrive, you'd be buying from a company that just experienced a 39% delivery collapse, posted its first loss in 3 years, recalled 11,000 vehicles over fire risks, and is desperately discounting products to maintain any sales momentum at all. The profitable exception turned out to be a temporary condition that evaporated under competitive pressure, and dealers who bet their businesses on that exception are now managing the consequences. Recalls and competition killed Li Auto's momentum. The next company got killed by a 5% tax change overnight. Xpeng was the tech-forward choice. Advanced driver assistance systems that rivaled Tesla's autopilot. Cutting-edge AI capabilities. The company positioned itself as the Chinese EV brand for people who cared about software and autonomous driving technology. Their marketing emphasized innovation over price, a premium positioning built on technological differentiation. In 2025, Xpeng ended the year claiming they'd achieved their first ever quarterly profit. Chairman He Xiaoping said the probability was 5 nines, 99.999%. The tech press celebrated. Investors who'd held through years of losses finally saw a path to sustainability. Then 2026 arrived, and everything fell apart. In January 2026, Xpeng deliveries collapsed to 20,011 vehicles, a 34% year-over-year decline. By February, they fell further to just 15,000 units, dropping below the 20,000 mark that analysts consider minimally viable for a company Xpeng's size. The momentum that seemed inevitable in late 2025 reversed almost overnight. What happened? The Chinese government introduced a new 5% purchase tax on new energy vehicles, replacing the previous full exemption. The policy change hit the entire industry, but Xpeng got hit hardest because their vehicles compete in the most price-sensitive segment, the 100,000 to 200,000 yuan range, where buyers feel every percentage point of additional cost. The stock plummeted to a 52-week low of $16.13 in early 2026. While there's been partial recovery since, the fundamental problem remains. Xpeng's gross margins on vehicle sales can't cover their R&D spending. They invested 2.43 billion yuan in R&D in Q3 2025 alone, a 48.7% increase year over year, while their average selling price per vehicle kept declining. You can't spend more while earning less and call that a sustainable business. For European dealers who partnered with Xpeng, the story sounds familiar. The company expanded aggressively into Germany, Norway, Denmark, the Netherlands, and Sweden. They signed dealer agreements, established service networks, and promised growth trajectories that would justify the investment. But among the big 3 Chinese EV startups, NIO, Xpeng, and Li Auto, industry analysts now call Xpeng the most volatile entering 2026. Their positioning in the mainstream price segment means they're the first to feel any market pressure. When competition intensifies or subsidies change, Xpeng absorbs the hit before anyone else. Their sales respond immediately to market conditions in ways that premium-positioned competitors can partially avoid. The company is now pivoting away from pure vehicle sales toward becoming a technology supplier, licensing their autonomous driving systems to other manufacturers, similar to what Huawei does with Ato. That might be a smart long-term strategy, but it's also an admission that selling cars alone isn't working. For buyers considering Xpeng's potential arrival in North America, the question is simple. Do you want to buy from a company that's already pivoting away from its core business because vehicle sales aren't sustainable? Xpeng's pivoting away from selling cars. The next brand is backed by the biggest Chinese automaker on Earth, and that might not be enough. Zeekr. Zeekr is Geely's premium EV brand. The technology looks incredible. The 001 shooting brake is genuinely beautiful. The specs compete with anything from established luxury brands. When Geely's global communications head said at CES 2026 that they expect to announce a US market strategy within 24 to 36 months, automotive journalists paid attention. But look at what's actually happening within the Geely empire, and a different picture emerges. Zeekr just delisted from the New York Stock Exchange. In December 2025, they completed a merger back into Geely Auto and abandoned their independent public listing. That's not necessarily a crisis. Companies restructure all the time. But it came after months of concerns about whether Zeekr could survive as a standalone brand. Meanwhile, Geely's other premium EV brand, Polestar, is in crisis mode with a going concern warning and 95% stock collapse. Their budget EV brand Geometry quietly disappeared. Lynk & Co., another Geely brand, just got absorbed into Zeekr. The parent company is consolidating because spreading resources across a dozen brands isn't working. In August 2024, Zeekr faced significant customer backlash after launching the 2025 model year of the Zeekr 001 just 6 months after releasing the previous version. Customers who'd recently bought the earlier model found their vehicles superseded by a newer version with upgraded technology that couldn't be retrofitted. The CEO had to publicly apologize. There's also the question of whether Zeekr's sales numbers reflect actual customer demand. According to Reuters and the China Securities Journal, many Zeekr vehicles sold in Xiamen in December 2024 were pre-registered with insurance under corporate affiliates before being sold to retail customers. Of 2,737 vehicles recorded as sold that month, only 271 were actually registered for license plates by real buyers. For potential MAFPO North American buyers and dealers, Zeekr represents both promise and risk. The vehicles themselves are competitive. Geely has the resources to support a market entry. They could potentially manufacture at Volvo's South Carolina plant to avoid tariffs. But you'd be buying from a brand that just delisted from public markets, whose sister brand issued a going concern warning, and whose parent company has a track record of launching brands and then quietly consolidating or abandoning them when they don't perform. The dealers currently considering Zeekr partnerships in Canada and the US need to ask hard questions. What happens if Zeekr becomes the next brand Geely consolidates? What happens to parts, service, and warranty support if Geely decides the North American market isn't worth the investment? Look at what happened to Polestar dealers. Look at what happened to NIO's European partners. Then make your decision with open eyes. 5 brands, billions in losses, dealers burned. Before you buy from any Chinese EV brand arriving in Canada, check if the company behind it will exist in 5 years.